A very warm welcome to the On the Tape podcast. This beautiful October that we're experiencing in the Northeast, Dan. How are you?
I'm doing great. It is beautiful here.
It's unbelievable.
Yeah.
I mean, it is autumnal, yet it's warm enough where you're enjoying yourself outside.
Feels like we're kind of stealing time a little bit here, guy.
Stealing time.
Yeah, like it should be, like you said, autumnal.
I like that. Stealing time. Be a good name for like a book.
Yeah.
Stealing Time by Dan Nathan.
There you go.
This is On the Tape, by the way, by Dan Nathan. Typically, Danny Moses joins us. However, Danny's not with us today. However, you had a wonderful conversation with the co-founder and CEO of Current One, Stuart Sopp.
Yeah, so Stu and I had a great conversation. We talked really about the yield move. We talked about the Fed's direction. We talked about what the bank stocks had to say about the consumer in Q3 and how they're thinking about them into Q4, some of the stuff that they're seeing through the lens of their fintech companies. So great conversation. I think it'll be very useful if you're trying to kind of parse out the kind of rate cutting course and then what it means for the consumer.
Yeah, no doubt. And we've heard from Discover, we've heard from American Express. So I think you could tie a bow on all the things we've seen already and some of the things that I think are going to happen. But let's just talk about this week real quick and get into next week, because next week I have a host of really important earnings: Google, AMD, Apple, to name a few. Mm-hmm. But this week, what I thought was interesting, Dan, and I'm curious your thoughts, the move in the bond market, and again, I'll lead with that because I do think it's the most important thing. Since the Fed lowered interest rates by 50 basis points in the middle of September, 10-year yields have only gone higher, and they've gone basically from about 3.55% or so. I think at its zenith this week, we were 4.25%. As we're doing this today, it's either side of 4.2%. That suggests one of two things. Either the economy is doing much better and rates are going higher because of it, or something far more nefarious is taking place, and I think that's what it is. I think the inflation genie is not in the bottle. It's still out of the bottle, and I do think the debt and the amount of issuances that need to be done over the next couple of years in terms of just supply and demand are going to make rates go up. By the way, I'm not the only one that thinks that. Paul Tudor Jones was on CNBC earlier this week. He, too, is short bonds, thinks they're going higher in terms of yields. And Stan Druckenmiller, 20% of his portfolio now is short bonds, playing for yields to go higher.
Yeah, a whole host of like techno reasons that you guys have been highlighting as it relates to the deficit. And basically, I think the Paul Tudor Jones thing is like, how do we inflate this debt away?
That's right.
Right. So I understand all that, and I am no expert when it comes to that. I think some of the inflation expectations also have to do with the fact that, the world is a pretty messed up place right now. So if we thought that, the supply chain disruptions that we had, and COVID and after COVID, and you think about just reshoring, like all of that is inflationary, right? So there's a whole host of reasons in the near term why you could say that. What did you used to say that inflation was going to be, Guy?
Pesky and persistent.
Yeah, that was a very common theme late 2021 into 2022 with you, and you were really very correct on that. Listen, this is a tough one because when I think about, late 21, you had all of these, you had SPACs, you had crypto, you had unprofitable tech IPOs. All this stuff was going ballistic, partially predicated on this free money sort of thing, right? There was a ton of capital sloshing around. And then as we got into 2022, and it was very clear the Fed was going to raise rates to battle said inflation, stocks got sold off. They, like all that stuff that I just mentioned, it was, but it was very orderly, right? So in 2023, everyone came in thinking that we were going to be in a rate cutting cycle. It never happened. So it just had the first rate cut in 3.5 years or something like that in September. And your point, this is the craziest thing I've seen in any market. The fact that rates got killed into the cut, you have a cut that's greater than expected. And what happens from the day?
Yields go higher.
Yeah.
And what's interesting, people say, well, that means they need to cut again. And I listen, I don't know this to be the case, but I think if they were to announce on Monday a surprise 25-point cut, I think 10-year yields would go higher. And that's clearly counterintuitive, mm-hmm. But I think what's going to wind up happening is the yield curve, which was inverted for the greatest amount of time in the history since they've been monitoring this stuff, which is now steepening, I think that's what's going to continue to happen. The yield curve will continue to steepen, and people will say, well, that should be a good thing. As Elizabeth Young Thomas points out many, many times over the years, it's not the inversion that gets you in the yield curve. It's the re-steepening, and we're in the midst of it now. And if yields were to continue higher, it suggests, again, that maybe inflation is not under control and maybe all the issuances are going to have to come out are not going to be as robust as we've seen historically.
Yeah, and so going back to the point, 23, 24, we're 3/4 through 24, a little bit more than that. And you think about, what's been driving a lot of the performance. Obviously, mega cap tech was a big part of that for, right up until I think this summer. You did see it broadening out, whether you hate that term or not. If you look at the way the BKX is traded, that's a bank index, and you look away some of the, the biggest names in that index, they have performed amazingly well. Many better than the Mag7, if you think about it. And like JP Morgan has doubled the performance of Microsoft. It's doubled the performance of Google. It's, up a lot more than Amazon. So just think about that. I mean, so I just go back to the stock market guy with that whole yield conversation, and I say to myself, okay, so let's just say the Fed passes on the November meeting. Let's just say they pass on December. Right now, the CME Fed Funds Tracker is pricing a 90% probability they cut 25 basis points in November and a 70% probability they cut 25 basis points in December. That would leave Fed funds down there at the upper band guy, 4.5%. Doesn't change a whole heck of a lot because stocks were raging when, when the 10-year was 4.5% like 6 months ago.
Well, think about it. I mean, the market started rallying on the back of potentially 6 rate cuts this year. I mean, at one point last year, they were anticipating 6 rate cuts this year. We're obviously not going to get there. With that said, a lot of that is in the market already. And again, why are they cutting rates? Like, what are the reasons why? By the way, it's, again, not just me. Kevin Warsh was on CNBC earlier this week, and he talked about the same thing. Like, he didn't deem it necessary in terms of the magnitude of the cut. So we'll see. That's that. What was really fascinating this week, there were a couple stories. I think one of them is Tesla, which, by the way, we will get to. The other one was McDonald's. And if you think about what came out on, I believe, what was it, Tuesday night or Wednesday? I think it was Tuesday night. E. coli, they were not able to identify it immediately. Subsequently, they identified it in, I think, 5 or 6 different states. It was the slivered onions, not the diced onions on quarter pounders. The initial reaction of the stock was to take it to about 305, 306, down to about 289, 290. The reaction function, though, with the company, I will say, was very, very good. And the only thing I really have to compare it to is CMG back in October of 2015. So you had the E. coli breakout at CMG in October, another one in December. People were hospitalized. They were never really able to identify what was going on. They did a horrible job in their communication. And the stock went down, I think, 60% or so over the course of about 6 months. I was not suggesting that would happen with McDonald's, but I did think it was going to trade poorer than it did. But the fact that as we're sitting here now on Thursday afternoon and McDonald's is either side of 300 into earnings next week, by the way, on the 29th, suggests that maybe in terms of crisis management, they've been able to do everything right.
Right. And to your point, though, it's only been a few trading days here. And so it's a tough lens to kind of look at it in such a short period of time. They're going to be asked, I mean, listen, that call is going to start out with long commentary about this situation. I don't think anyone else gives a crap about, like what happened in the quarter. And really, they want to focus on what they think the potential implications are for the quarter that we're in right now, Q4. There is a scenario, Guy, where they maybe pull guidance for Q4. And, and so the question is, what happens there? If you look at this stock over the last kind of year and a half or so, and you made this point on many occasions, it literally has been trading between $250 and $300. So it had a runaway breakout the last few weeks or so. You get this piece of news. And I think part of what you're saying also is that after a move from, I want to say a few months ago, from 250 when it was making new 52-week lows to kind of getting back to the prior highs at 300 and then just kind of breaking out, you have this sort of news. You shoot first, ask questions later.
That's what I thought would happen. I thought it would definitely be sell first, ask questions later, wait for some clarity. But that only took about 24 to 48 hours. Now, again, I think there are probably more chapters here, and I'll be flat out say when this came out, and we're doing this on real time on Fast Money Tuesday night, when it was trading around 290, I thought the likelihood of it trading back down to 250, which, by the way, was the low in October of last year and was the recent low that we saw in the middle of July, made a lot of sense. We obviously got nowhere close, but to your point, let's see what they have to say next week when they report earnings.
Yeah, and again, from a technical standpoint, if this is how you trade, I mean, the 200-day moving average is about, I want to say 280-ish, guys. So, you look at 250 up to 320, right? You can do that math. That probably brings you to a 50%-ish retracement or so. And at that point, the stock's probably fairly cheap and might be discounting some of this stuff. So, again, the last thing I want to say about this, guy, is part of that move that we had off of those 52-week lows was really this push into these value meals, right? And that was something that I think folks or consumers were very receptive about. So if we get in this period once again that we're worried about inflation, it's going to find itself into trucking and food and all those sorts of things. So they may have to go back to discounting, and they may have to go back to heavy discounting to get people back in their stores.
Then the last week and a half or so, the S&P again made an all-time high, right around 58.80. I think the exact high was 58.78. But it's doing that, Dan, on the back of a volatility index, which historically, when I say historically, over the last 5 years, let's call it, as the market's been making all-time highs, the VIX has been hovering somewhere between 13.5 and 14. The fact that we're still either side of 19.5 or so at these still elevated levels, the S&P, suggests one of two things. Maybe the market has positioned themselves ahead of the election. God forbid something bad were to happen post-election, or the market is setting itself up for a bit of a disappointment to the downside.
Yeah, and I think a lot of people are scratching their heads about this sort of behavior. Like you said, the S&P is just down 1.25% from those all-time highs made pretty recently. I think you could probably kind of say, you know what, it's some hedging in front of the election, because I think a lot of people are not, in the camp that this thing is going to be done and dusted by the morning of November 6th, right? And you and I have to go all the way back, to 2000 when we had this hanging Chad situation, right? The Supreme Court was involved, and it took a couple months, you know what I mean? And so that sort of uncertainty, especially when you think of the backdrop of just the monetary situation, some of the geopolitical sort of stuff. I mean, investors don't like uncertainty, so it makes some sense to kind of hedge up, I guess, especially if you're a big, long short hedge fund or something like that. I'll just say the last thing about the VIX. So, the average price of the VIX over the last year has been about 15. Okay, and that's higher, than most, for the most part, of what you would expect in a VIX that's trading at an all-time high. So trading here at 19.5 seems like a bit excessive. If you look at the average over the last 5 years, though, which obviously includes the pandemic and a lot of the volatility we had there, it's 21. So for all intents and purposes, I think what it speaks to is that, people, there's a lot of uncertainty here, and the gains, you might want to lock them in, and that's probably what's going on in the VIX.
Could be, without question. We mentioned there's some earnings next week, and now it starts to get interesting, right? As we get to the end of October, into November, towards the end of the year, we're going to hear from Apple next week, but before that, we're going to hear from Google and AMD, and I think they're both really interesting. They're all their own stories to a certain extent, but they're all important stocks for the broader market. What's fascinating is, if you think about AMD over the last year or so, the moves that it's had from peak to trough and then to trough again have been staggering. AMD, which seemingly was on a breakaway on the back of the whole AI phenomenon, gave the entire move back. And now we're sort of hovering here. I don't think the market is really able to figure out what AMD is. Is it an AI stock? Probably not. Are they at the cutting edge? Probably not the way they were. Is it a valuation play? And I think that's why at $154 or wherever we are, by the way, having seen the stock trade north of $225 or so in the spring of this year, the market can't figure it out either, Dan.
Yeah, and I think it just kind of speaks to this sort of euphoria that we've had in the market around this kind of mega trend, if you will. And, AMD a year ago, Guy, was trading just under $100. And to your point about getting to like 227, that was in early March. I mean, think about that move in less than 6 months or so. It was about 5 months, from 100, let's just say, to 220. And since then, I mean, it's been in a series of lower highs and lower lows. Lisa Su, the CEO, keeps coming out and talking about the TAM, the total addressable market for, AI. And maybe we are just in the second inning or so, but this company does not seem to have a product that's competing with Nvidia's high-end GPUs. And we've highlighted the fact of a Micron, of a Dell, a lot of these components, right, that go into these servers. A lot of these companies that were swept up, or at least their stocks in the enthusiasm, have really, the fever's broken a little bit. And it feels like it's just Nvidia and a handful of names left.
I mentioned Google. So Google made its all-time high of, I think, $191 and change in July of this year. Since then, it was pretty much a straight shot lower into early September, and we've been basically flatlining around 162 or so. I think the good news for Google is on valuation in terms of balance sheet, you can make a very compelling case. But quite frankly, that's been true for quite some time. It's been underperforming for a reason, and maybe there's a bullseye on their back in terms of what some of the rhetoric is around the company and breaking up the company and those types of things. Maybe that's part of it. But I think there's something else going on here. And if you think about it, I mean, it really comes down to ads, right? And maybe the ad business is not as robust as some people might like to think in this economy right now.
Yeah, and I guess the question is, if you're looking at, you're doing web searches through ChatGPT or Perplexity, it's giving you a contextual answer. It's citing where they get those from. So if you were to go to Google and you put a search topic in there, and it used to be that you get 10 blue links, one of them is sponsored. That's how they made most of their money. So right now, that seems to be an attack on their business model. They've owned that business globally. So I think that's weighing on it. You know, there's another thing. I mean, when you think about this performance of this stock, they got a few things right on Gemini. That is their large language model. They're going to be, implementing that across all their major platforms. And I've been using it. It's good. I mean, if anyone uses Gmail, use YouTube, there's a whole host of other things. It's working pretty nicely. But again, what does it mean for their advertising base? And then on the regulatory front, the key issue there is if this company is forced to not be able to have that exclusive search relationship with Apple, and Apple has made to open it up, that's a huge issue for them on the traffic front too.
No question about it. You mentioned Apple. I'm going to talk about Apple, but a company that I believe reports on the 29th next week, not confirmed yet, but you're probably going to be hearing from them within a week or so, is Supermicro. Now you say, why are you mentioning SMCI? I believe, and you have it in front of you, they're, if not the third, they're the fourth largest customer of Nvidia. Mm-hmm. So they're obviously a huge player. This is a stock that was everybody's darling, if you go back and look, into the spring of this year. I think it traded up to $120 or so, pretty much in a straight line. This is all now post-split numbers. If you look at where it's trading now, $46. That is a significant drawdown in what was a stock that was loved by everybody. Clearly, they have their own issues without question. However, my concern is where there's smoke, there's going to be fire elsewhere. So I am keen to hear what Supermicro has to say, one, and to see what the price action on the back of it is, two.
Yeah, this stock is a no-touch for a whole host of reasons. There was a short report out about it, right, a few months ago. There was also, I think there's an investigation into the business here. Like, to your point, it is a large customer, Nvidia, about 8% or so. It's greater than that of Alphabet, and just below Meta. They've been buying these, Nvidia high-end GPUs that go into the servers they make, that go into, these data centers that are training the large language models. And, when you think about who are those guys, it's Google, it's Microsoft, and it's Amazon's AWS. So when you think about what we just said about AMD not having a product, about Micron having disappointing results, the memory that goes into the servers, if you think about Dell, which is obviously a competitor of Supermicro, I mean, some of these stories are kind of falling a little bit by the wayside. And then the last thing I'll just say, I just mentioned the three hyperscalers. Google is only up 16.5% in the year. Microsoft is only up 13.5% in the year. Amazon's up 22% in the year. The NASDAQ is up close to 20%, and the S&P is up close to 22%. Mm-hmm. So the AI trade is kind of losing a little steam, especially relative to the major indices.
You mentioned Microsoft. Microsoft reports on the 30th of October, which is next week. And again, expected earnings for the year, the out year, I think, if you look at basically year over year, they're going to go from $13.20 to about $15.30. So decent earnings growth without question. And you probably have, I don't know, maybe 9-10% revenue growth for a company, Dan, that's trading, even with the bit of a sell-off we've seen, of about 31 times next year's numbers, which historically is expensive. So Microsoft, I've said this before, it's one of the 3, if not 5 most important companies in the world. I think we're going to learn a lot more about the AI trade and obviously the whole cloud business when they report next week.
Yeah, I mean, with Microsoft, it's kind of interesting. You could maybe make a case that relative to its low teens earnings and sales growth, flat margins, and considering their positioning with OpenAI's technology, that 32 times this current fiscal year, it's 2025, is not so unreasonable, especially when you look at some of the valuations around here. But like investors clearly think there's going to be a deceleration and maybe that the company has to guide down a little bit because the stock is down 10% from its all-time highs made in July, I think, of this year. And like I said, it's only up 13.5%. If these three stocks, the hyperscalers, are driving a lot of the adoption, if they're offering a lot of the compute, if they are supposed to be the ones at the center of this, you would think these stocks would be performing better. You might say to me, okay, well, they outperformed last year, but it was very nuanced back then. I mean, people really couldn't kind of put their finger on what the use cases are, what the return on investment was. And so with Microsoft, we've quoted over the last few months lots of scenarios where a lot of their customers are not seeing those use cases. You know, Mark Benioff was out this week, the CEO of Salesforce, talking about the co-pilots that they're like introducing, and they're hearing from their customers they're not that interesting either. So that'll be a major theme. We saw forward estimates come down for Microsoft. They came down for Google over the last quarter. Let's see what they guide to, because if there is a decel, these stocks are going lower.
If you look at a chart, very short term, the potential for a bit of a head and shoulders pattern, the first one being in March, and then obviously you just talked about the July all-time high. The second shoulder would come in middle of September or so. I hate round numbers, but in terms of Microsoft, believe it or not, $400 is a pretty critical support level, basically the low we made back in April of this year. So just keep that in mind at a $424 stock, the importance of that, not only to sentiment, but to the broader market as well. And again, Apple on, I believe, Halloween Day, good for Apple, Thursday of next week. It's going to be fascinating to hear what they have to say, because there have been bull calls over the last couple weeks, and there have been some bearish calls as well in terms of the demand story out of a pretty well-respected analyst. Now, with all that said, the stock is within $5 or $6 of its all-time high. It's been trading extraordinarily well since that June 10th event.
Yeah, so
it is expensive though, Dan.
Yeah, and you know, again, this is a stock, you made this point on many occasions when it was, didn't have the growth. It was trading like a growth stock, and, then it was trading like a value stock once it had the growth. I think the main point here, and one of the reasons why this stock shot up 10% in the days after their Worldwide Developers Conference when they introduced Apple Intelligence, is that a lot of the analysts and a lot of investors thought this was it. This was going to be the thing that causes this upgrade super cycle. We heard numbers of 300 to 400 million iPhones that were 3 to 4 years old, and Apple Intelligence was going to be the thing to do it, especially after a few years of low single-digit unit growth for Apple. And then the story, and Gene Munster, good friend of the pod, was making the case that day, he was making the case, is that the applications that are built on top of these large language models, that's going to help them get a greater multiple, because the service revenue that they get from that is going to be that much greater. So I get that, but I'm not sure the upgrade cycle is happening. Now, when you talked about the bullish trade or call and the bearish one, the bullish one was an analyst saying that, China, which is 20% of their revenues, they're seeing unit growth up 20% in this quarter, okay? Well, here's the deal with that. China is not going to have Apple Intelligence. It's not going to make it by their firewall. So it must be a situation where you need a new iPhone. That's why you're doing it, and that's why you like this aspirational product. In China, some people think there's 100 million iPhones in China that need to be upgraded. Now, on the bearish side, there was an analyst came out and said, the builds are kind of not as great as possible. We're going to slow it down by 10 million units. This is a company that's supposed to sell 220 million iPhones. So that 10 million number is not particularly significant. So October 28th, this is, I think, next Tuesday, Apple Intelligence, or at least some of the features, are supposed to go over the air, upgrade cycle. I know, Guy, you're going to be lining up to do that. And
I love that. It's my favorite thing to do.
But if it starts getting good reviews by people with the iPhones in their hands, then you probably get a level of optimism. So this is going to be a really interesting quarter. I don't think you should expect much of it, but what the next quarter guidance looks like, that's what this is going to trade off.
Agreed. And again, obviously, Apple being a bellwether for the market, although I will tell you, there was a period of time where Apple was trading extraordinarily poorly, yet the stock market was still going higher. So that's sort of shot out of the water any notion that I had that is the market goes, Apple goes, or vice versa.
Well, you mean earlier this year?
Earlier
and
this
we know
year.
what happened. I mean, Warren Buffett was selling,
Yeah.
half of his stake. He was literally sitting on the stock. He was keeping it all capped up. And given the euphoria in and around this trade and the optimism about what Apple was going to come out, if he wasn't selling, Guy, this stock would have already been at new highs.
Probably right.
Yeah.
There's one story that we have to talk about now. It came in the form of Tesla earnings on Wednesday of this week. Now, again, I am not a Tesla bull. I'm not anything. I try to find levels and identify trading opportunities. And they reported their earnings again on Wednesday. I was struck by their margins. I was struck by their free cash flow. And I thought in the wake of that, and again, I was not bullish going in. I want to be crystal clear. But in the wake of that report, I thought it was logical for the stock to trade up to these prior highs that we've seen of 260 or so. And as we're sitting here on Thursday, you have a stock that's trading about 258. Couple things before I go to you. Yes, margins were better, and I think the market is interpreting that as sort of basically a turn in terms of margins. They're going to start to reaccelerate the right way for them. We shall see. Robo-taxi, everybody's all geeked up. And what's fascinating about this, two of the analysts that we've known for quite some time are totally different ends of the spectrum. One end, you have Tony Sacconaghi, who is at Bernstein. He's a genius in terms of analyst. He has a $120 price target in the wake of this, and he maintains an underperform. The flip side of that coin is Adam Jonas at Morgan Stanley, whose target remains $310, and he maintains overweight. I only bring that up because you can look at the same stock. Carter says this all the time, and you can have two different basically scenarios based on how you're looking at things.
Yeah, I mean, listen, and I'm not a fan. I'm not short the stock. I've been kind of just sitting and watching and listening because, people were very disappointed about the robo-taxi. We were sitting on the desk. I think it was October 10th, that event. And the next day, it was very disappointing. The stock closed down 10% because of that. So people buy this stock in anticipation of what Elon might say and the path forward, That quarter, I think the expectations kept on coming down. We had the delivery number already for Q3, but expectations were coming down in margins. They put this big beat up. It expected to be, something like gross margin 17 or some percent. I think they came out 19.8. A lot of folks that have been digging into this, they think there's some funky stuff there, one-time sort of things, and then obviously R&D and cost of goods sold. There was a lot of funky stuff going on there. So if you think it was a gross margin turn, if you think it was an automotive gross margin turn, that's why you're buying the stock up 21% right now. So we're Thursday into the close. This stock gapped up 13%, hasn't seen a downtick all day long. This is pretty powerful action for a $800 billion market cap company. I'm not saying you have to step in front of it, but I actually think that in the not so distant future, if you think about what Elon had to say about robotaxi, full self-driving, a lower end car below the 30,000 price point, I don't think they're going to hit any of those targets. And why do I think that? Because he never has.
Right.
Not on timing or on price. So if that's why you're buying it right now, it doesn't make a whole heck of a lot of sense to me, especially when you consider the kind of price war that continues to go on here that has weighed on margins, the buying down to rates. If you think rates are going to stay here or go higher, it remains a difficult story in that regard. So to me, and then there's some stuff going on here in the United States, how he might be, alienating part of the user base that are inclined, or the consumers that are inclined to buy these
Without
cars.
question. I mean, it also is important to mention that this was a stock, by the way, that made its all-time high north of $400 a share in November of 2021. So despite this huge move to the upside, I mean, this is a stock that has been completely underperforming the broader market for the better part of 3.5 years. And I just mention that because in context, I think it's important. We are at resistance levels here. We'll see how it trades next week. One thing that's been trading extraordinarily well under any circumstances, dollar up, dollar lower, yields up, yields lower, has been gold. Gold continues to seemingly make new all-time highs every single day. And oh, by the way, silver for the first time in a while is starting to play catch-up. Now, I don't necessarily know what it means. I think I know what it means. I think a lot of it has to do with the money that China's throwing at their economy and their markets, but the gold trade, Dan, is alive and well.
It's funny. We cover a lot of different risk assets. We obviously spend most of the time on stocks, right? But we look at some of the related sort of stuff, and you could take gold out of it for a second and say, well, I don't see much relation to the stock market and the like. This chart up 30% in the year, and you have been a buyer on any pullback, Guy, the thing is, there haven't been too many pullbacks.
None.
If you go and look
August
some January.
5th, right? You had that huge sell-off. Like all the risk assets got whacked. And since then, it's been very shallow, the sell-offs.
But it never actually broke down. You know what I mean? It never took out any technical levels. Why are we talking about technicals? A lot of folks who trade gold, they look at technicals there. You know, they look at the relationships of the dollar. I think the most important thing that you just said is that the Dixie, the U.S. dollar index, has rallied from 100 to 104. That might not seem like a big move. People, if we're talking about a stock, you'd say 4%. But in currency terms, that's a lot. And you would say that gold is supposed to act inversely to that of the dollar. Well, gold has just gone from 2,600 to 2,735. You know what I mean? While that dollar move happened. So this is easily one of the best charts in the market. When I say that, you know, yeah, it's not Nvidia or it's not Meta or anything like that, but there was not any instance this year where you had to be nervous about owning gold.
One day, maybe. Other than that, it's been on sort of autopilot, and we'll see. You know, again, I think I understand what it's sort of suggesting. And again, we have an election now within the next 2 weeks that for whatever reason, the market outside of the VIX doesn't seem to be all that focused on. We'll see if it gets more focused on next week. As I mentioned, big earnings week next week, some economic data that we'll be talking about. I still say watch the bond market. I think you can take a lot of your keys from that. And in the meantime, we're going to continue to chug along here, Dan.
Yeah, so I think it's on Thursday, Guy, the PCE. This is the Fed's most favored inflation index there, or metric here. And this is the one, and we can end on this too, right? Because we know that once we get to next Friday, it's going to be Nov 1. And then following Friday, we'll already had the election. Who knows if it's going to be settled or not. But then we're going to have the October jobs report. And it was that September jobs report, Guy, that really got yields going because it was so strong, right? So the perception is that we have a stronger than expected economy, right? And that might reflate, you know, all those inflationary things. Is that right? Can I say reflate
you
inflation?
You can say that.
Is that, it's not too much flate?
No, I think I think it works.
So, you know, that's the issue, that you have strong growth, you have inflation coming back, and then you have a Fed that just got off sides with their rate cut, right? I mean, like, so to me, everyone was pricing in the potential for Jerome Powell to nail the landing. But, you know,
he's still in the air. He's still in in the middle of one of those flips or something.
Sure.
He hasn't stuck
triple
anything
Lindy
yet.
The triple Lindy.
I'm a big fan of that.
Yeah.
When we come back, Dan's conversation with Stuart Sopp, co-founder and CEO of Current. So stick around.
Welcome back to the On the Tape podcast. Dan Nathan here. Stuart Sopp there. He is the CEO and co-founder of Current. Stu, welcome back.
Thank you for having me again.
You know, one of the things, we really enjoy, I think every, 4 weeks, 5 weeks, we get together, you sit down with us, we spend a lot of time on the U.S. consumer, some of the stuff that you're seeing through the lens of your customer. We also, talk about the macro a little bit, you as just a reminder to some of our regular listeners, but maybe some new listeners. In your past life, before you became a fintech founder, you were a macro trader focused on currencies and yields and, precious metals, a lot of stuff. Okay. Obviously, you also became really focused on the Bitcoin. We're going to hit some of that. So we're going to drill down on the U.S. consumer, some of the things that you heard in the Q3 earnings season. We'll also talk about some of the stuff that you're seeing as it relates to other founders out there. You were just at a conference on the West Coast and heard a lot of different things and the like here. All right, let's talk about the Fed. Let's talk about yields. Let's talk about what I think is a super curious move over the last, call it, month or so. The Fed cut interest rates 50 basis points on September 18th. Fairly well telegraphed. It was at least going to be 25, maybe 50. It was kind of controversial. Let's talk about that. This seemed like, first of all, it was the first cut, I want to say, since 2020 or 2021.
Yeah,
all right, so it was at least 3 years. Why do you think there was so much debate whether they're going to go 25 or 50?
I think I was surprised by the 50, just candidly. Yeah. So I was going into that going, the economy on X or Twitter or whatever you want to call it now. And so I was sort of, before the announcement, sort of saying, maybe there's like an insurance cut, a sort of political, not being political, but look, it's an election year. I get it. Let's keep
people
things
worried about volatility.
Volatility, because people freeze up. And there could be genuine liquidity sort of concerns over an election period, especially one that we're seeing now. So I was like, look, maybe 25 kind of makes sense. And then I think it was a week before the Fed, or as into that weekend, and literally all my hedge fund friends spun on a dime, and the word was out, it's 50, right? Or something. It was like a whisper stream. And so I was, you know, they were the smartest people I know, and they were all out saying 50 really early on. And I was like, I know I trust you, but like, I don't get it, right? So
that happened all at once.
Yeah, within a day, right? It was like Saturday or Sunday or something. So I don't know, one of the Fed speakers was out, or maybe someone was at a conference. I don't know what happened exactly, but there was like, you know, top-down telegraphing that we're going to do 50. So surprised by it. I think, you know, is it a policy error right now? Not yet, but like the data since has been pretty good, right? So things have been okay, and so you've
so when you're talking about data, the inflation data has not been running that hot. The employment data is better than people expected. So that's kind of the debate where if we had inflation data picking up, right, and we had actually jobs ticking down, you might get into a stagflationary environment. In that way, no one knows what the Fed should do, right? Because we haven't been there in a long time.
That's right. Yeah, stagflation is clearly the risk and would be the sort of kryptonite of any central bank, right? Since the 70s. It's something that you don't want, and you have to do you have to pick a poison in stagflation. And we all know Volcker picked his poison in the last time we saw that. So, I think the 10s moving. Well, let's talk about the 2s. 2s went from 350 to like 4
since the cut. So it ran. So people were positioned for that move lower, right?
Yeah.
And then all of a sudden, why did it turn on a dime like that?
I think the data.
So 355 to your point, and it's kind of been stuck here at like 404 or something like that.
Yeah, I think the data isn't bearish enough. It went from sort of hard landing to soft landing. We're in that no landing, sort of perfect landing kind of thing. And then the data since then, I think, has been okay on balance. Of course, there is some detail in that. I think also people, the market is pricing in a Trump victory sort of in sort of real time. And so that the idea here is maybe there's more growth and maybe things are not as bad as they would be. But
doesn't that mean lower rates too? Like that's the one thing that I'd be confused about, because going back to his last term, you know, he was really browbeating the Fed to keep lowering rates anytime they had the opportunity to do so. As a ex-real estate guy, you know, that was kind of his mantra in general. So it is weird, because you're saying that what you're seeing in markets in general is supportive of a higher growth sort of environment.
Higher growth,
but when you talk about some of the, like a lot of economists, and this is coming out of the Wall Street Journal, which you know is kind of in the bag for him, you know, they're talking about his economic proposals could add $7 trillion to the deficit, you know what I mean, over whatever period of time. And so you'd think that would be something as a massive headwind to growth ultimately.
Yeah, I agree with you on the headline. I think the people I talk to in the markets don't think, and this is pretty unanimous from those same smart people I chat to, is that Trump, despite all the rhetoric around tax cuts and like $7 trillion, and he's promising, everyone's promising candy in this election. It's crazy. The thought is that he's not going to be able to do a lot of it, and even his tax cuts that are, you know, $400 billion that are meant to roll over, he might not roll them over and things like that. So I think people are sort of saying, oh, we're getting to this sort of debt level where people, the private sector and markets are sort of saying, bond vigilantes are saying, we're at the end of this thing. We got to do something different. And I think the market is slightly pricing in that. And you've seen it from PTJ and Bill Ackman and others on CNBC recently, of just like, you know, it's like we're selling treasuries, right? We'll sell the long end, right? And
meaning they think yields are going higher.
Yields are going higher, and long commodities, and there's this rotation basically. There's a position being taken from the markets, I think, and from sort of smart people at the moment who are saying enough is enough. And this election, despite who wins, regardless of who wins, we're sort of not playing that game anymore. Now, who wins on that trade, I don't know, but like that's the position that's being taken right now.
Yeah, so interesting. So the CME FedWatch tool pricing, so there's a meeting on November 7th. That's 2 days after the election. I think a lot of folks kind of feel like there's not going to be a clear winner by November 7th anyway. I think the point that you made about that September cut, I mean, for the better part of late spring into summer, a lot of folks were like, you know, the Fed's probably not going to go in September. They don't want it to be viewed as political. This is supposed to be a non-political entity. So the fact that they went greater than expected, you're saying to yourself, wait, what are they seeing, right? Is the landing so soft, or so no landing that they have the ability to kind of do that because they're fearful of that rate being too restrictive at a time where maybe it shouldn't be. The CME FedWatch tool is pricing a 93% probability of a 25 basis point cut at the Nov7 meeting, and then a 70% probability of a 25 basis cut in the December meeting. So that would have the upper bound, okay, at 4.5%. So let's go back to the move in the 2-year, which is obviously most closely tied to Fed funds. So it was 3.55 in and around when the Fed cut rates. So folks just got in front of that in a big, big way. And then since then, it had that huge one-day move a few days later. And now here we are stuck around 4. The fact that it hasn't gone meaningfully higher, I think speaks to the probabilities of further cuts. Does that make some sense to you?
It does. I think I was even talking internally for our own projections in 25, because obviously we're a little sensitive, not massively sensitive, but a little sensitive to the Fed and the cost of money. And so I was sort of thinking, even at 3.5, I was saying, look, I think over the next 12 months, we price in 4%, and that would be the 2s, right? So I think 4% is the right level for the market to price. Now, it doesn't mean it's not going to go up and down from here,
right?
But I think it's probably hit its fairest level at this point. Now, in terms of like, do they cut 25? I'm unsure. My gut feel would be that they would do every other meeting at 25. And so let's see if that plays out. I think there's one thing that I've been thinking about and haven't really expressed really to anyone is that, and
let's
see
break some news right here. Come on,
it's just locked in my head and my shower thoughts. But maybe you can comment on it and let me see if it's crazy. Is that, have we entered this era of Fed policy where it's really fiscal policy? And we're cutting 50, and we may cut 50 again because we can't afford the interest payments.
So that's the whole, you heard PTJ, you heard some of these guys, that's Paul Tudor Jones, these folks saying, well, what has any economy done in the past when they're this indebted? They try to inflate their debt away. And I think that's what you're kind of getting to a little bit. So you actually didn't come to you in a dream. It was basically something that you heard on CNBC. Let's just be really, clear about that.
They cut 50 because they're fiscally dominant now, meaning they're looking at the trillion plus, interest payments, and they're seeing it go. We're adding a trillion every 100 days, 90 days, or something like that. And we're like, okay, we're bankrupt, and so it's not about the health of the economy. It's like now the health of the balance sheet and the treasury, and also they're going to have to factor in who wins in this election and what they're going to do. So I think between now and January, there's a massive uncertainty because everyone's promising everything, but we don't really know.
All right, so because of that uncertainty, if you're looking at the old Federal Reserve playbook, they would continue to ease. So like if you go back and you think of the 25 years that you and I have really been focused on markets and some of these sorts of economic issues, like you would say that their playbook has always been to lower interest rates when there's some sort of shock to the system. And I guess one of the things you could say is November 7th and then the December meeting, there's a pretty decent likelihood that we might not have, an election that's settled at that point. And that sort of economic activity, you would see headwinds to economic activity. If you're a CEO of a company here in the U.S., you're going to hold off on any sort of plans that you might have for, M&A or CapEx or capital raising or whatever the hell it may be. You know what I mean? So that's one reason why, if you just use the term seizing up, the Fed would do that most likely. Now, they run the risk of re-inflating inflation. You know what I mean? Like that sort of thing. So again, it's a very complicated case mod. You see what I did there? A lot of ins, a lot of outs, a lot of what have yous here. Let's move on a little bit from the yield picture because again, I just don't think we're going to have a lot of clarity, but the Fed fund tool at the CME is basically saying that we're going to be at 4.5 on the Fed funds, in the December meeting. Let's talk about the dollar and the way that has moved of late. Obviously, it's moved in lockstep with yields, but when you see this sort of move, and I know that you're really focused on what's going on with the yen, and what do you think is going on? Is it more this move from 100 in the Dixie to 104? Is it more to do with yields, or is it more to do with some other kind of macro issues that you've been focused on?
Yeah, it'd be hard to put like a weighting on it because I'm just not close enough to the flows anymore. But it is definitely dollar yen and yields, right? I mean, I've been quite a big proponent verbally on like dollar yen going down, and I think end of the carry trade and all that other stuff. Sure, hyperbole, but there was some decent carry trades taken out down to 140-ish, and then people have been adding on the way up, and so you've seen those levels like 149, 152 where we are now, and in the low 140s. And I think we've just with the move in the 2s and the 10s, and like with the yield cut, I think there's just massive positioning. And I think the DXY obviously is over-indexed on euro. I'm sure it is still. But when the yen moves so much like that, I think it's taking the DXY with it. So
right. And
I think that's what it is.
So let me ask you this though. Yeah. So if you go back and you look at that movement, a lot of folks, Guy Adami was one of them, was remarking about the volatility that you had here. And if you saw the crescendo, was in the stock market here in the US, and some of the hardest hit names were some of the, most volatile, highest priced tech stocks. Okay, that was into that August 5th day. You also had, the yen kind of bottomed out in and around there, I think, into that early set period. And now you've had this move from 140, up to 152 or something like that. What do you expect next? What's the knock-on effect here? If you were to see a move back towards 140, okay, so this would be the third time in a year, you know what I mean? What would happen? Like, if you're unwinding that carry trade, is it, high valuation, high growth U.S. stocks? Like, where do you go first, I guess?
Yeah, I think, well, from here, given my yield view, which is the 2s are probably fairly priced, but, volatility aside, be up and down. And then the 10s probably have some pressure on, especially, politically, I think, as well. So I think you're going to see. So basically, the dollar's done most of the stopping, and it should stop around here, I think, in terms of dollar yen. So I think dollar yen probably comes off from here, would be my bet.
Okay.
And then in terms of like rotation out, to your second part, I think out of, and again, I may have just a shower thought, or it might have been PTJ. But it could have been both, right? Yeah. I think there's a rotation out of Mag7 at this point, and I would be cautious. I am cautious around those big names right now, and I think rotation into small caps, commodities, and some currencies.
Yeah.
And I think commodities, obviously gold is doing well. Silver, some of the what I would call shit coins, silver is a shit coin to gold, and that's starting to move, right? There's a rotation out. And I think you then get a further move into things like uranium, which is seeing a little bit of a dip.
And it's a fundamental reason for uranium. This kind of push towards nuclear, and who's doing the push towards nuclear. The large hyperscalers are signing deals, right?
Right. You've seen 3 Mile Island get signed out by Microsoft.
By the way, can you imagine what that's like coming back on after 40-some years? You think they've been maintaining it really well? So. It's probably we're close in there, right? You know what I mean?
Well, we got to put our money where our mouth is. I've been shouting from the top of the hill that we need to go nuclear, and we need higher density of energy for these data centers and for the future of America and the Western world. And so it'd be very hypocritical if I was like, oh, don't open.
So you've been saying that because of the focus 5 years ago on the energy consumption for crypto mining. That was something that, folks were like, wait a minute, it takes so much energy just to kind of, make one coin, or whether the hell, the measurement was, or whatever. So it was kind of a precursor to what we're seeing right now. Because for all intents and purposes, whether you're training a large language model or you're mining Bitcoin, is a lot of energy needed. And a lot of folks right now, I think this is kind of the through line, is a lot of folks 5, 6, 7 years ago were like, what's Bitcoin for? Why are we spending so much time and energy, you know what I mean, mining this thing? And right now, as it relates to generative AI, it seems like the people that are all in on it are technologists, you know what I mean? Or people that actually, all of a sudden now here's a solution to some of their most complicated computing, or, you know what I mean? Like logistical sorts of things. But the jury's still out. Is that fair to say? And we'll get to more of this a little bit later, but
what is the jury still out on Bitcoin in general?
No.
Use case for?
Use cases for generative AI.
Oh, generative AI specifically. I think we have a deflection of 20 or 30% right now using Gen AI, which is a very valuable, healthy thing. So great customer experience, as well as we're reducing costs. And I think every company, I was at a conference last week, and it was a broad-based sort of sector representation, and they were all saying, if you haven't started your Gen AI or AI type project, you should start, like, you're already behind it, right? And so there's this pervasive thing around, I think, in American business right now, where there's a massive focus of like cleaning up your data, data governance, getting that in a good spot, then getting into Gen AI or some form of AI cost improvement. But that's cloud 2.0 to me. That's where it is. I mean, Trevor and I have been pretty vocal about this. Is that at this point it's cloud 2.0. It doesn't mean that going forward AI isn't going to do amazing things like this AI agent. I don't know if you saw that, right? With Mark, sent some money to this AI agent. Now it's got its own meme coin. Did you see this?
No, I didn't actually.
Yeah. So Mark Andreessen sent $50,000, I think, of Bitcoin to this AI agent that then. That basically his job was to go make $1 million. And so it created a meme. And you can Google that meme, because I'm not going to say it on this podcast because it's kind of gross. But like it's a Gnosis meme or something like that. And I think the market cap is up to $1 billion.
Wow. So this is an agent that obviously it's not programmed by any human, or it's just kind of generating on its own. And actually, so that sounds really interesting. I mean, I think there's needs to be a greater, kind of understanding between AI, which is an extension of machine learning. This is stuff that you've been focused on for a long time, because you have been focused on this kind of consumer experience, how to take cost out, being more productive, that sort of thing, versus generative AI. And it's interesting because once ChatGPT came on the scene, it was like people were putting in like prompts and saying, remember there was like the Jerry Seinfeld thing that went on and on and on. It kept on generating plots based on what it knew about past plot. Well, that didn't end up being too productive, right? And when you go back to what you just said, cloud 2.0, I think that's really interesting, because if you look in the stock market, some of the worst performing stocks in tech, Snowflake is one of them. Snowflake is down 40%. What does Snowflake exist to do is manage your data. You know what I mean? Then you think about a company like Adobe, down on the year. Adobe is not about your data. It's about creating things. Well, you would think that generative AI would be very useful to them. They've already laid out their plans of how they're integrating it. That was a year and a half ago. Stock trades horribly. It's down on the year. It's down, it's 13, 14% or something like that, or it's actually down 19%. So there's a whole host of names in the public markets that are not participating at all.
Yeah. I think Adobe, they've talked a good game. I read something recently that most of their new AI tools are coming out, and like you said, it's been a while, but this is a fast moving market. And so if you're not in the front of it, I think you're just going to get punished.
But some have been in front of it talking, Salesforce, Mark Benioff has too. That stock massively underperforms. I think he was out recently talking about Microsoft's Copilot is calling him not particularly useful, that sort of thing. So that's my point about the use cases. Like I'm not sure they're there yet.
If you look at Palantir, live in the same building, right? Close to 100 billion market cap. They've promised a lot, but they're actually executing on it. So I think, there are winners and losers already happening in the AI space.
So it's interesting though. They might be winning on the technology front, that sort of thing. But this is a company that's expected to do less than $3 billion in sales this year. Their earnings are kind of paltry. Their net income on a GAAP basis is like $463 million, this year. So think about that, 2.7 billion in sales, and it's trading at 121 times earnings this year, 35 times sales, 100 times next year's expected earnings, and then 29 times sales. So my point is like
it's expensive.
That's amazing that they're executing and they're in front of things, but the market's off sides on this. Like, how do they grow into that valuation?
Well, this is where I think the market is doing the winners and losers, right? So I think it's basically AI is the ultimate power law, because and I think what's happening is companies that are actually doing it and using it and seeing some success, the market is sifting binary. It's like a binary sift. It's like that is the winner. And people are willing to pay a lot of money for
Same thing in Nvidia. I mean,
exactly.
You're seeing it in different parts of it, but it's interesting because at some point, if your cloud 2.0 thesis works out into 2025, then it's going to get around to the snowflakes. You know what I mean? Like they'll have their sorts of move. Let's get back to kind of focused on what we heard out of Q3 earnings over the last, let's call it, few weeks from some of the biggest financial institutions, and maybe kind of draw a line to what you're thinking about the consumer, like some of the stuff that you're seeing. So as it relates to JP Morgan was one of the first ones out of the gate. Here's a few things that I know you keep a very close eye on. So they said increased in debit and credit card sales volume by 6% in the quarter, robust acquisition of 2.5 million new card accounts. I think that is, so talk to us about like what they've been able to do. Now, obviously, this is a company that was able to buy a regional bank in the crisis. This was probably in Q2 of 2023. Do you think that's where some of this acquisition is happening and some of the increase that they're seeing in card sales and the like?
100%. So, I think there's two parts. One is, they're sort of swallowing two big acquisitions, right? And so if you talk to anyone at the exec level at JP Morgan, the sort of this year is focused on assimilation and like integration. And so you're starting to, and they're very good operators, I think, especially in this space. So I think some of their growth, and that will, I think, continue this year into next year because these are very large sort of purchases. That's one thing. And then I think secondarily, the market for the retail consumer, and we have a very specific segment, sub 620 FICO, sort of slightly poorer, less affluent than the average of American, are still okay. Things are still okay, and we're growing very, very quickly as well. So I think from a high level, from the data and the people that I know, things are okay. The U.S. consumer still hasn't, it's not broke. Now, you look at net savings rates and all this other stuff, yes, there is pressure, but there's also
higher credit usage too,
higher credit usage and filling in the gaps. And like there is a sort of like almost always a binary outcome in America, but you're also seeing asset prices like pretty high still and people are doing okay.
So it's funny, there was this optimism that the housing market would kind of loosen up a little bit with rates coming down. You saw mortgage rates come, 30-year from, 7, down to 6 and then back. And now they're going back up. So what you just mentioned about the U.S. consumer in pretty good shape. I mean, if you look at what Citibank said, with Bank of America, with Wells Fargo, they all seem very cautiously optimistic. The term that you hear again and again was consumer resilience. One of the things I took out of the JP Morgan commentary, though, that they also reported a net charge-off rate of 3.24% in their card services division. Okay, so they're saying that there's a little stress here in the consumer.
There is on some of the unsecured revolving. Did you see the Apple Card numbers?
Yeah.
So the Goldman Sachs Apple Card numbers, like 8%.
Yeah,
it was massive, right? And I think Citi are around 4%. I think Citi has always been considered like sort of slightly negative selection bias, but that now you look at like Apple.
But Citi said signs of financial stress among consumers with lower FICO scores.
That's it,
right?
Yeah. So that's the binary outcome I'm kind of alluding to, is that when in the bull market, when the Apple Card was launched and people went sort of wide in the private and public markets, and what I mean by wide is typically there's bad product market fit for a low FICO score for an unsecured credit card for all the obvious reasons, right? But in a bull market, when there's sort of infinite free money, there was pressure to grow, and even for these big companies. And so the lower FICO scores are starting to do what they always do, which is like they start to charge off pretty high, and they have an over-indexation of those cohorts. We at Current don't have an unsecured product for these people. We have cash flow underwriting that is basically against their paycheck, and so making sure that if they've still got a job and we have better data than the credit bureaus, we can underwrite them better, and we can also give them a product that isn't as sort of heavily penalizing on the downside.
So based on this, cautious optimism about the consumer. Obviously people are keeping a close eye on these charge-offs. They're going to keep a close eye on credit usage. They're going to keep a close eye on unemployment and what that might do for all of this. But again, right now it feels okay, and all of that should be benefited to some degree if you see basically rates come down and unemployment not go up meaningfully, right? So like that is basically the soft landing scenario. Is that fair?
That's fair.
Okay.
Yeah. And into your other point, I just remembered something again was if we cut again another 50 over 3 or 4 months or whatever it is, and mortgage rates continue to stay around 7, I think the new government will start to have like sort of yield curve fixing or control, whereby they will probably heavily incentivize or discount mortgages for certain selected groups, or maybe just go into like the long end and start adjusting it.
Right.
And so I think that will happen next year if this persists.
Well, there's a lot of policy on both sides where, helping first-time home buyers, trying to, create more, inventory. All of that will take years if you think about it, right? Yeah. So you're not going to see any quick fixes as it relates to that. So in general, you have not put your kind of toe in the water on the credit side right
On the
now.
mortgages,
So
yeah.
you're seeing, pretty decent activity, though. You have a lot of direct deposit, right, from a lot of folks in the lower, like you said, FICO, who are working couple jobs.
That's right.
So again, we want to keep a very close eye on that lower end consumer. The higher end, though, we see some odd stress from some of these, like kind of luxury brands and the like. So it'll be interesting to see what happens if we see a slight meet in the middle over the next, let's call it a few quarters or so. Just in general, on the let's get back to the markets in general. So it's interesting to me that financial services are the second best performing sector in the S&P 500. Lagging is communication services and technology. And you just mentioned something about the Mag7 and the like. And you also mentioned that the investors are picking winners and losers as it relates to this strong secular theme. So just in general, as we go into 2025, if all the focus has been on these perceived winners, whether it's Nvidia in the chip space, whether it's Palantir and the applications and the like here, are you expecting this to kind of broaden out? And I'm saying this through the lens of a guy who started a financial services company. Is the next leg of this generative AI trade into other industries? You just mentioned this conference that you were at. It was a whole swath. It wasn't just technology people. Are we going to see it in logistics as it relates to air freight and this and that, whatever? Are we going to see it, as Guy's been mentioning, in a company like Walmart that's seeing an acceleration in their e-commerce because of some of the solutions that you're doing? What would some of the early adopters, in what sectors would you think would be beneficiaries?
Yeah, that's a good question. Yeah, at that conference, there was broad-based sector representation, like I mentioned, and everyone was focused on AI. And I think these are great companies, quality companies that take a little bit of time to get that, applied internally. And yes, I do think everyone at that conference, including the bankers, which maybe they're paid to do, were cautiously optimistic for 2025. And I think And I think that was broad based. So from biotech to logistics, like you mentioned, transportation, as well.
Biotech will be a big one, right? If you see advances, but it's going to take a long time before regulators get their arms around how these companies are using this technology.
Yeah, I think AI is pretty interesting in some of the folding protein space and these things that are like heavy compute that we never really had the ability to do before. So cancer drugs and things like this, super interesting. I think, Wegovy and all these others,
GLP-1s.
the GLP-1s is like this first wave. You can see the power of when something works and everyone needs it. The power and basic monetization of these things is insane.
Well, mRNA that we saw, in obviously creating some of the COVID, vaccines and the like, or we'll just call them shots at this point. That was without that technology, it would have been really hard to do. Yeah.
That's right. Yeah, and so I was really interested and intrigued that AI and compute from AI was being applied to some of these things. So I think there is a speeding up of sort of these power law drugs, these power law transportation solutions, and so I think it's broad based, and it probably some of it starts to come in 25. So the promised productivity gain and lift that we've all needed in America needs it, right? Maybe not as much as Europe needs it, but we still need it. May start happening in 25. Yeah.
Well, let me ask you this, because Trevor, Marshall, who's your co-founder and CTO of Current, and he and I have had some great conversations on this. Google Cloud is obviously a big partner of yours.
Yes.
And, for a while, all these cloud companies, whether it was AWS, whether it was Microsoft Azure, there was tremendous demand for compute, as a lot of these companies that we just kind of, or in these different sectors, were kind of figuring out how they're going to use this technology. Now, obviously, there was plenty of companies in technology that were obviously using this compute, and there's a whole host of them in the private markets that we don't get to look at on a daily basis because they're not banging around in the stock market. So there was tremendous demand for this compute, right? And as every industry and so many different companies were kind of moving in, a lot of these companies, because of what they were spending on the high-end GPUs to kind of put these models on their clouds, that sort of thing, a lot of demand, it was getting really expensive. Are you seeing that loosen up a little bit?
Is it cheaper basically?
From a pricing standpoint?
Yeah, I think there is.
As more capacity.
It's more, more capacity, and it's just more competitive. Let's be honest. Yeah. And so I think it's Mark Andreessen again quoting is the quickest commoditization of any tech he's ever seen.
Right.
So it's very quick. So foundational models, is kind of done. The way I see this in terms of high level is Gen AI and what we've just seen in the last couple of years is a piece of the puzzle, and to try and like take that piece and say that's the whole jigsaw is just not accurate. It's a bit like the internet in like the 90s. It's like we all know where it's going, but it's going to be one piece of but the internet was a piece of the puzzle. And I think over the next 5 to 10 years, you're going to start to see the puzzle complete. And so it maybe take like a Waymo or an Elon robo-taxi is a really sort of visceral thing that you can imagine is, AI, real world AI that enables a major productivity event whereby you can buy a car for $30,000 or $40,000 and it has a yield. And you can imagine that yield would probably be Fed funds plus 4% or something. And then there's going to be a massive oversupply because everyone wants a car that yields, pays for itself. And then eventually those rides are going to be so cheap. It's going to be cheaper than the MTA, right? It's going to be $2 to go anywhere. And then all of a sudden things like parked cars on the side of the road are going to be gone because you don't need parked cars, right? Why are we parking cars?
And what fills in that gap?
Right.
What happens?
So there's a really exciting thing where like
you can't even see the thing that's going to happen 20 years out.
That's an EV thing with real world AI plus like transportation and manufacturing advances. And when it all sort of comes together, you start to see it's like an amazing different productivity and a different world, actually.
Yeah, so we can't even kind of envision it. I mean, there were folks, let's say in 1999, who envisioned a service like Uber that was built on a mobile network that was built, you know what I mean? But like very few people could kind of see that. And even if you tried to build that back in, let's call it 2002, it was a massive failure. You know what I mean? So I find that all pretty interesting. The one thing I'll just, and I'd love to get your quick sense on this before we get out of here, if the technology is being massively commoditized and people like Mark Andreessen are already seeing that, right? And these companies or his company invests in a lot of really crazy founders who want to do that next crazy thing and the like here. But I wonder if there's been all this demand for Nvidia's, Hopper, and now, folks are transitioning to Blackwell. And Blackwell, so far, and it might be really early, it's obviously promises, far better speeds and, all that sort of stuff. But if they're having issues as it relates to this transition, they've already seen some bugs and the like here. If we see the commoditization, if we see the prices coming down, is there going to be tremendous demand for some of those products in the very near future? And the only reason I ask that is because Nvidia, next to Apple, is the second largest market cap company in the world. It trades at like crazy multiples. So, and I'm not asking you to opine on the individual stocks, but like, are we about to see this digestion phase for some of these companies?
It's totally possible. And so for some people I talked to last week, there was like, I wouldn't say it's concern yet, but like discussion about like, is this plateauing? Have we hit the compute plateau, right? Is this, what are we getting from this next one? How much is it, is the cost appropriate for what we're getting out? So it's basically back to unit economics. Is kind
and
of
return on investment.
Return on investment, exactly. I think there are slight rumblings from now happening. And I think you're right to pick that up. I think now, you talk to Stanford PhD type people and they're like, look, the thing that we're building right now will be ready in 2 or 3 years will fundamentally change like even like the energy requirements and things like that. So, we're all making big bets on these sort of energy returns. Nat gas probably a good buy given the data center requirements. But if they fundamentally change how it computes, then okay, maybe that's not a good bet. So I think it's still up for grabs.
Yeah, and I'll just make this last point. So the S&P right now is very near its all-time highs. It's up about 22% on the year. And if you talk about these large hyperscalers, which is really what we're talking about, the ones providing this compute, they're the biggest customers of Nvidia in the stock market. Microsoft underperforms the S&P. It's up 13.5% of the year. Google underperforms the S&P. It's up 16%, on the year. Amazon is in line with the S&P. It's up 22% of the year. So I think market participants are already starting to see what you just said in a way. So if you get into this digestion phase, if you get into this phase where the technology that they've basically been able to kind of charge pretty healthy, rates for, okay, like if they're starting to underperform and there's overcapacity, then these stocks could have a really difficult 2025.
Yeah, and I think that's right. I think the Mag7 and these, I think it is a broadening, a back, and I think rotation into small caps and things that would benefit, like some of these, at a better price, I would say.
Well, retail could be one of them, right? So
yes.
If Walmart is massively outperforming, Walmart is up, almost 60% of the year.
It's crazy.
Think about that, right? So it's outperformed most kind of, stocks in the technology market year to date. Then you would expect to see maybe Target gets the benefit of that next year based on some of the investments they like. All right, Stu, we covered a lot of ground. I really appreciate your, the color on the U.S. consumer, what you heard out of the financial services sector, but obviously what you have to say about generative AI and how you as a company are integrating it into some of your products and services and the sort of productivity gains that you guys might see. And really, I think what you would say is what is the value being delivered to your customer through these sorts of investments? And we hope to hear more and more about that as we get into 2025 for you. So I really appreciate you being here.
Thank you for having me.
Thanks.